Hi, I'm Dan from Applied Education, and today I'm going to be talking about what is Fringe Benefits Tax and how is FBT calculated. So first we need to understand what FBT is, and it's basically legislation that was introduced in 1986, and prior to this, businesses were providing things like cars, corporate boxes, lunches, all tax-free and potentially unrelated to an employee's work, maybe even giving their spouse a car, um, and their families, executives, with little obligation for the business to make the benefit related to their employee's employment. So the whole purpose of this legislation is for the government or the ATO to receive the tax that would have been paid had the employee paid for that item out of their own salary after tax or take-home pay. The difference being FBT is calculated on the highest marginal tax bracket, regardless of what tax bracket an employee is actually on. In this article, we won't be defining what is and what is not exempt from FBT, rather just the concept of FBT calculation. So first thing, or second thing, is the payments of FBT, and that tax is the responsibility and obligation of the employer and paid for by the employer. Generally, employers may claim as an income tax deduction any cost of providing the FBT and the amount of FBT paid. At the end of the day, it's an obligation for the employer. The FBT year is 12 months beginning 1 April ending 31 March, and the ATO requests that businesses lodge their FBT returns by the 21st of May. FBT rates for 1 April 2020 is 47%, which is the highest marginal tax rate, including Medicare levy, which is also 47%. So you can see there that the FBT rate is in line with the highest tax rate for an individual. All right, let's get on to how is FBT calculated. And basically, the FBT that a business would owe, the ATO, is the value of the benefit. So what it is, the value of the benefit that you gave the employee, including any GST potentially, multiplied by what's called the gross up factor, multiplied by that FBT rate. So there's two types of FBT. Type 1 gross up factor is 2.0802 if there's GST in the price. Type 2 is if it's GST free item, let's say it's residential rent is an example, or private health cover is GST free, so the type 2 would be 1.8868. So we need this gross up factor in our calculation. Let's look at an example like giving the employee a free house to live in. Paying their residential rent. Now, let's say we're not going to look into the details again of special rules and exemptions. Let's say an employee lives in Perth. They, all their life, their work has just said, hey, here's free house to stay in, and the business is paying the rent. So if the business does that, it would have to lodge an FBT return, and let's say the benefit's $5,000. So 5,000 times 1.8868, as there's no GST in residential rent, times 47% gives us $4,433.98 in FBT that the business would have to pay. So what does that benefit cost a business? 5,000 in rent to the landlord, 4,433 in FBT to the ATO. So it's cost the business about $9,500 to give someone a $5,000 benefit. And we'll come back to this in a minute when we look at marginal tax rates. Let's also say we gave an employee, Brett Smith, a $5,500 Sony camera in recognition of his online course trainer of the year at Applied Education. So that camera cost us 55 in GST times 2.0802 being the gross up factor times 47% means 5,377 would be the FBT we pay. So the cost to the business would be 55 to the camera shop, Even though the camera is not work related, because we're putting it through our FBT return, we can claim, the business, being we, can claim the GST. So 500 we claim back on our business activity statement, plus the 5377 in FBT payable. So the cost to the business, 9488.47. So there's our two examples, both costing about $9,500 to the business. All right, now let's relate that to a person's take-home pay. So Brett Smith, we're going to look at if he'd paid for it out of his own pocket. Let's say this employee earns more than $180,000 per annum. You can see that their tax rate on the amounts over that amount would be 45 cents plus Medicare levy of 2%, so 47% tax bracket. Now, looking at the example, we have rent of 5,000. You saw that the FBT was 4,433 and it cost the business 9,433. Look at the second row of that table, the bottom row. Someone on the top marginal tax rate would need to earn 9,433.96, and to work that out, to get 5,000 in their take home, to work that out, 5,000 times 1 minus 47% equals 9,433. So to give someone $5,000 benefit, they would have to earn 9,433. They'd pay PAYG of 4,433 to get their 5,000 take home. So really, someone on the highest tax bracket is no better off, and in actual fact, it's almost exactly the same. So the government either gets it as FBT or PAYG. The second example there of the camera, you can see it's 9,488, and the FBT would have been 4,488. To earn 5,500 in take home, using that calculation, 5,500 multiplied by 1 minus 47% is 10,377. So you'd have to have PAYG paid of 4,877. So someone on the highest tax bracket, again, it works out almost identical, and they're no better off. I haven't done people on less than 180,000, but in that scenario, if they're paying for the benefit either way, obviously they are worse off because the FBT would be higher. So you'd rather pay it out of take home. All right, so that's the FBT equation and how it's calculated. In regards to income tax consequences of providing a fringe benefit, as previously mentioned, the cost incurred is an allowable tax deduction to the business, and from an employee's perspective, a fringe benefit is exempt income in the hands of the recipient. There are implications though, quite a lot. So before acting on any of this, obviously get professional advice. And if you want to learn more about salary packaging and FBT, visit us online at www.appliededucation.edu.au. Thank you.